in forecasting how to position your trades for the coming week or more. And one of the things I want to look at, I got 3 charts particularly to zoom in on, is just what is the U.S. stock market predicting going forward from here. See, a lot of people have been looking at this chart. Let me share my screen here, and there we go. This chart, and saying, hey, we are due for a recession in the U.S. The reason for that is that this chart compares the 10-year note, the U.S. Treasury. This is, a bond that you can buy from the U.S. government, and basically you give the U.S. government some money, and they give you back a rate of interest over 10 years. Okay, that's the 10-year note, and you subtract from that the yield of the 2-year note, right? So if the 10 years paying out 5 and the 2 years paying out 3, then this number should be at 2%, this black line. If for whatever reason the 2-year note is paying more than the 10-year note, this would be a negative number. Well, that's the case right now. They refer to this as the inverted yield curve, because shorter term bonds are supposed to pay a lower yield than longer term bonds, because longer term bonds have more risk because they have more time. And therefore, to attract investors, all of the things being equal, they should have to pay more interest. So goes, economic theory. Well, anyway, the idea here is that if you track these two and you watch to see, hey, which one is paying out more, and is the yield curve inverted, meaning this number is less than 0, does that imply economic conditions are troublesome? And in the past, every time this thing has gone negative, after it comes back out of being negative, then we have seen a recession in the United States. And here, this is going clear back to 1990, so you can see the last 3 recessions. This thing dips negative, and then the first time it seems to come out of that dip, then we get this period of couple of quarters of recessions. In 2000, there was a more serious one. In 2008, even a more serious one after that. But notice that these things dipped negative, and then it was on the way out when the recession actually got going. Well, part of that is because the way they count recessions, they're kind of backward looking. And so economic conditions get bad, and then it's like 3 to 6 months later, they kind of look back and say, oh yes, now we're in a recession, right? So that's part of the reason you see it this way. But this inverted yield curve that we have seen beginning in the summer of last year, so we've been inverted for more than a year now, is the deepest and longest, I think, on record, going back for probably 100 years. And so people that feel like this indicates a recession ahead are looking at this and saying there's a huge, terrible, big, bad recession coming, and yet it hasn't really shown up yet. Yes, we've seen more economic difficulty in the United States, but we haven't seen the kind of numbers that make people feel like we're truly in a recession. Now, if you zoom way in, notice this. This line made a very downward trend until just recently, when it's kind of broken that trend. However, just the past week has made it, we've seen this line dip down. In other words, the 2-year yields have started to increase relative to the 10-year. And what that means is that we're not heading up to get out of this line, and we kind of have to get out of this line for the recessionary periods to start, or that's what people tend to say, because what happens is when the recessionary situations come on, then interest rate yields come down, and they come down faster in the front than in the back, and so that's kind of how that dynamic happens. But we're not there yet. We're not seeing those kind of interest rate turns, and with this dip down, that means that hey, maybe the recession isn't imminent yet, right? So with this little dip down, some people have been looking at this and a lot of other evidence that maybe the recession, maybe the market is not doing, not going to be so bad for the next 2-3 months. But I want to show you. Drat, looks like I closed that chart. Let me just open up this chart really quick and do it this way. There we go. And show you that the chart, the S&P 500 right now is actually looking pretty. Let me remove these lines here. Is actually looking pretty bearish. See how we've seen this thing go up, come back down, and make 2 lower highs. Last week it looked like we were going to rebound, but we ended up just turning, and maybe that's a lower high going forward from here, right? And notice also, especially right here on October. So this is something I really pay close attention to. At the change of quarters, of the financial quarters through the year, I notice that the U.S. market will respond to kind of what they think, what big money thinks is coming next. And usually if you have large institutional investors say, hey, we think next quarter is going to be good, and they'll dump a bunch of money in. And on the days right before, like the 3 days before the end of the quarter, then they're usually buying. But here, in fact, they were selling. Green, or these blue candles are good going up, and red, orange going down, right? So if you look at this, you realize these right here are selling. There's one buying day, and then there's selling. So 3 of the 4 days leading up to the end of the quarter were selling days. And then the first 2 days coming right out of the gate of the new quarter, those are often indicative as well. And so in this case, what did we see? We saw a sort of nothing day, and then we saw a significant down day. So right here, this is sort of giving away what institutional money thinks is the next quarter's activity. And that's down. And so here we came running back up, but now we're starting to sell. Could it be that this is the beginning of the turn? Well, I feel like the answer is, but before I go on, let me just say, you see the euro, this is all very similar to what's going on with the euro, right? The euro's gone up, but it's been making a very significant downward trend since July there, right? And you see that with the similar pattern of the stocks. July, this one topped out here in late July and then started coming down. Yeah. So what does that mean? Well, I feel like that is an indication that you're going to see continued weakness in the euro, at least for a little while, continued strength in the US dollar, and continued weakness in the S&P 500. However, I don't think that we're looking at a huge bear market, it's not 2022 all over again, right? If you look at this chart, it looks like it certainly could be. We certainly could be headed for that, right? So why do I think that that's not what's coming next? What I think is coming next is we're going to go down a little bit, but at some point, there's going to be a really good buying opportunity. And I don't know if we're going to take out these lows or if we're just going to come close to them. but somewhere here over the next couple of months, we're going to see a low that's going to be an excellent buying opportunity. Let me show you why I say that. First off, the 10-year inverted curve, which we already talked about, it's still not all the way back up. So recessionary times, if they come at all, are not imminent. They're not really close. But here is an indicator that I look at for just moments like this. In 2013, I was co-author of a book that was published, the title of which is Invest to Win. You can look it up on Amazon. It's still out there. Tony Turner and I wrote that book, and we did some research to look for an indicator that sort of predicted downturns in the market. And here's what we found. We found that if you compare the utilities sector with the S&P 500, and you look for two things. First, you look for whether or not the utilities are doing better than the market in general. And the second thing you look at is the market becoming more volatile? Is the fluctuation increasing as measured by the average true range on a monthly basis? If you find that the market is becoming more volatile, the degree of fluctuation over the course of a month is increasing for 2 months in a row, and at the same time that utilities are outperforming the S&P 500 for 2 months in a row. If those two things occur at the same time, it's a big warning signal that, hey, things are about to get ugly, right? Well, going back 100 years, 9 out of 10 times that signal correctly predicts that troubled times are coming ahead for the market. This, where we are right now, utilities are doing more poorly than the S&P 500, and the average monthly fluctuation, the ATR on a monthly basis, is declining. So neither of these are signaling that we're looking at some sort of conditions where we could be seeing a bear market. So I think that even though we are trending lower in the S&P 500, because we're not really showing conditions ready for a bear market, I think that we're going to see some sort of low be put in within the next month or two, and that low is going to be a very good buying opportunity for the stocks, for U.S. stocks. When that comes, it will probably also be a good turn for the euro, but we're not there yet, right? So what do I expect for the next week? Well, earnings season is about to get underway next week for the U.S. And so what you're looking at is the stocks that trade earnings or that report earnings first. JP Morgan, this one just released on Friday, right? And then you've got Wells Fargo, which should also be, and both of them, you can see they jumped up. They moved way up and came back down, but they beat their earnings. So it's quite possible that going forward, the earnings will be, positive, and that will make people feel good about it. But notice that this, here's Wells Fargo. They beat revenue sales by 3% and profits by 19%. That's a big beat, right? And how about JP Morgan? Not quite as similar, but still interesting, barely beating revenue estimates, but kind of handily beating profit estimates. And yet, what happened with both of these? They both went running way up and got sold all the way back down. So that tells me there are still sellers out there. There's still people that, no, I don't want to be exposed to stocks. I don't care if the news is good. And that's a big indication of continued downward movement when you hear good news, but the markets fail to respond positively to it. So I expect that we will see continued downward movement for a week or two, fluctuating up and down. And that means that the euro will probably see something similar. When people move their money out of US stocks, they put their money out of stocks and into cash, which for US investors, of course, means US dollar. If money is moving into the dollar, that's dollar going up and therefore euro going down. So I expect to see the euro trend lower for the next week or two. And somewhere over the next month, maybe we'll see a new bottom be put in and a turn that will be a very good buying opportunity. I hope that's useful to you. And until next time, be sure to take care and trade well.